Good afternoon, everyone. Welcome to today's course, The Power of Inc. My name is Anthony Watson. I am here on behalf of Robert Hall and Associates. Very much looking forward to sharing the wonderful world of income taxation with all of you, and specifically the topic of the power of Inc., a topic that is near and dear to my heart as not only a corporation owner myself, but an enrolled agent tax practitioner going on my 18th year with my firm, Robert Hall and Associates. And on an average basis, each year, our firm can incorporate anywhere from 200 to 300 plus entities on an annual basis. So we see a lot here at Robert Hall. So hopefully there's a lot of great information in today's webinar. Especially during a very unique time in all of our lives as we start to build business and take advantage of certain positions in our own financial world, and hopefully building legacy for the future. So today's topic, the power of Inc. Just really quickly, a disclaimer that this publication is designed to provide general information regarding the subject matter covered and nothing else. We are not attorneys. We are not legal advisors. We are tax advisors. We are not financial planners, and that this information may change in future years. So depending on what year or time frame you're watching this video, information may have changed, and so we'll be updating this information as time goes on. A little bit about me. I've been working in the tax industry for going on 17 plus years as a senior advisor with my firm. I am also the keynote speaker, an enrolled agent practicing tax preparation under Internal Revenue Service, under Internal Revenue Code, as well as any state within the United States. And we service just shy of about 11,000 tax filings per year as a firm. I myself, roughly about 1,200 filings per year. So we do see a lot here at Robert Hall and Associates. I work alongside a wonderful staff based in the Southern California area, Glendale, California, to be specific, but we do service tax filings across the U.S. in all 50 states. Robert Hall and Associates has been open in the Southern California area since 1971, so a little bit over 50 years now, and we do see a lot with well into the billion-dollar marker for clientele, managing, flipping, wholesaling, rehabbing, over $1 billion in real estate-related investments. So we do see a lot. We're kind of a one-stop shop for all of your financial needs. We offer tax preparation services, which is our main service. We do also incorporate small businesses. We have financial planners here in our building who we can refer you to. We offer payroll services. I mean, we're a one-stop shop for all of your financial needs. So keep this in mind if you are in need of any of these services that you see here on the screen. We do offer free 30-minute consultations. I will show you this towards the end of the webinar again, so that you can connect with us for a free 30-minute in-person or over the phone consultation. Through this free 30-minute consultation, we'll be able to review 2 years of tax returns that you filed, check for any possible audit triggers, any deductions that may look too aggressive on the return, or any deductions that are missed, or unique positions to take when filing your individual or business returns. And then we'll also add you to our free periodic tax email update, letting you know about any changes to Internal Revenue Code under future legislation or future administrations. But then also to let you know about our free webinars that happen almost on a weekly basis and get you that free education that you're looking for. So make sure to sign up for this free consultation. I will show you this screen towards the end of the webinar today. Jumping right into the bread and butter, what about entity selection? Is incorporating right for me? Is it the right time to incorporate? What are my options as far as entities are concerned? Well, the most common entity that you'll probably hear about is the limited liability company. LLCs are great for asset protection benefits. LLCs are the most common entities used for protecting large depreciable assets, such as a rental investment, whether it be commercial or residential. LLCs are more of legal entity structures because LLCs don't save us anything income tax-wise, but they do allow us to separate our business and personal assets from each other. And through asset separation, you achieve asset protection. So the more you have your portfolio diversified and separated into other entities, the better protected you are. If you need to dive more into the legal conversation of what legal protection an LLC provides to you, we'd be more than happy to refer you to our business attorneys to dive further into that conversation. But strictly and solely from an income tax standpoint, LLCs save you nothing in income tax. In fact, here in the state of California and in other states, there will be filing fees as well. But here in the state of California, the only thing that you might get hit with is a filing fee on the LLC, not so much an income tax, because LLCs are pass-through entities. And the tax liability itself is actually something that hits you on the personal tax return. Here in the state of California, however, we pay a parking ticket for parking our business in the Sunshine State, the wonderful state of California. The minimum filing fee each year for simply being incorporated as an LLC is $800 annually. But then also on the state side, you may actually end up having to pay a second filing fee, which is called the gross receipts tax. And that can range anywhere from an additional $900 up to about $12,000 per year, depending on what your gross income is that's being reported on the limited liability company return. LLCs can file in two different ways. They can file as single member LLCs or multi-member LLCs. A single member LLC is just you owning your own limited liability company, maybe with a rental property or a small business under that LLC entity veil. A multi-member LLC is also known as a partnership, where you have multiple owners of the LLC and you are now filing not with your individual tax return, but a completely separate tax return called a 1065 partnership. And that is the LLC filing fee if you have multiple members of the partnership. And that multi-member LLC files its own federal and state tax return and then produces something called a K-1 form, which reports the profit on your individual return. So they are still connected in some ways, but it is a separate tax filing, which means additional filing fees or preparation fees. Doesn't necessarily mean increased fees with the state of California, but because of it requiring its own separate filing from your individual return, there are two separate tax returns that need to be filed for that. So just be aware of some of the additional costs that you may incur by filing a multi-member LLC. Always be aware of the financial obligation. As far as the C corporation is concerned, C corporations are normally utilized for larger business ventures. The eBays, the Starbucks, the Amazons, the Googles of the world, because they have well over $10 million in gross revenue, as well as over 100 shareholders, they are required to file as C corporations. Most small business investors or owners will not choose the C corporation entity as the entity of choice, simply because they aren't required to file as a C corporation from their perspective, and also from the notes that we just went over, but also because a C corporation is a double taxed entity. So in the tax world, we look for what entity is going to generate less tax, less tax liability for you personally. And in this case, a C corporation is known in the tax industry as a double taxed entity. You pay corporate tax on whatever the profit is under the corporation, and then you pay individual income tax on whatever you've paid yourself as a dividend or a salary. So just be aware that a C corporation is taxed in two different ways. And the C corporation current tax rate for a C corporation's profit is sitting at 21%. And that absolutely could change moving forward. Old Internal Revenue Code had us sitting at about 35% corporate tax. And as of 2018, the C corporation tax rate is 21%, and that could be changing in 2023 to 28%. So just be aware that the C corporation is a double taxed entity, and that tax rate at the corporate level could be changing in upcoming years. More likely than not, will be changing in upcoming years. The only entity that has proven time and time again to save a self-employed business owner tax is the Subchapter S Corporation. Now, much like the other two entities, all three entities that you see here on the screen do provide greater asset protection benefit, but they don't all provide the same income tax reduction benefit. The Subchapter S Corporation plays a different set of games. Or plays by a different set of rules. One rule in particular is called the reasonable salary requirement, which we'll get to in a couple slides here. But we want to make sure that we understand that the number one benefit of incorporating is in fact asset protection. It is not the income tax benefit at all. But we do need to understand some of the financial obligations of filing as one of these three types of entities. And simply by filing as the wrong type of entity, you could be giving up a lot of the income tax benefit if you are not structured the correct ways. If some of you have already incorporated as an LLC or a C corporation, and you're thinking, well, after listening to this course, I should have actually set myself up as an S corporation. Well, don't worry yet. Pump the brakes because you haven't made the incorrect choice. We just need to convert your LLC or C corporation into an S corporation to receive some of this income tax benefit. So once again, the subchapter S corporation is the only entity that has shown us as business owners and as tax filers here in the US, has shown time and time again that it can actually help us keep more money in our pockets at the end of the calendar year, which we'll go into more detail in a couple slides here. But first question, probably the most important question is incorporating right for you? Is incorporating right for me? Well, that really all depends. In my consultation times with my clients, in order to determine whether or not incorporating is right for any specific or particular client, I have to ask three very important questions. I call it the interview process, when I interview my clients about whether or not they need to be incorporated or whether or not it's the right time to incorporate. Number one, what do you own personally? What personal assets do you own? What assets are attached to your primary Social Security number? That's the most important thing, because the number one benefit is asset protection, right? And if you own personal assets and you're starting a business, or you have owned a business for a very long time, but it's not incorporated just yet, you want to make sure that you're separating business and personal assets from a liability perspective. So number one, what do you own personally? If you don't own a home, if you have no inheritance, if you have no retirement accounts, if you don't have any valued assets, well, what are you trying to protect by separating your business and your personal assets? Nothing at the moment. But as you start to acquire assets, buying your first primary residence, buying rental investments, building wealth for yourself and legacy, you want to protect that wealth and legacy from any potential litigation or any potential hardship. And so number one benefit of incorporating is asset protection. We got to figure out, what are you trying to separate liability-wise from personal assets or from business assets? Question number two would be, what is the consistency of your net profit? We need to make sure that the fees that you're paying each year to file as a corporation or an entity structure, the California filing fees or other state filing fees, the preparation costs, the payroll run costs, we need to make sure that when you add up all of those costs, that incorporating is going to save you more than the annual costs that you're incurring. So financially, it has to make sense. So what is the consistency of your net revenue? Are you at that level of net profit that warrants the additional costs of incorporating? So that's pretty important, right? We're not in business and incorporating ourselves just to simply spend money, are we? We want to make sure that, number one, we're getting great asset protection benefit, and number two, that it might actually end up saving us more than it costs us on a year-to-year basis. So your tax advisor can assist with these calculations. Question number three is, what kind of risk and liability do you operate at within your industry? If you're a realtor, normally you have the insurance policies in place, the E&O insurances, the malpractice insurances, the liability insurance policies. So some of us may have all of the liability and malpractice and general insurance already in place. And so you're thinking, well, I'm covered in case anything happens. I don't need an incorporated entity. Well, other businesses, even with all the insurance protection in the world, some other industries, like maybe a skydiving instructing business, they run very high risk and liability in what they do. So at the end of the day, probably doesn't matter how much insurance you have. You absolutely want that business incorporated and the liability and risk separated from any personal assets that you may own. So as you can see, the advice will change depending on what industry you work in. So once again, just to recap, question one, what personal assets do you own? Question two, what's the consistency of your net revenue? And question three, what kind of risk and liability do you operate? What level of risk and liability do you operate at? So these are very important questions to get answers to in this interview process, to make sure that we are pushing our clients in the right direction and suggesting for them to incorporate, and that they are going to receive all of these benefits at the end of the day, and obviously can cover the costs of doing so. So incorporating is not right for everyone. I do want to mention that before I move on. Incorporating is not right for everyone. So when you leave this course today, take this information to your tax advisor, have a conversation with your tax advisor about whether or not it is right for you specifically. Just because your friend, your family member, your coworker incorporated does not necessarily mean that you should go out and incorporate your business or put your property or title your properties under a limited liability company. It all depends on each individual's unique and specific scenario. So always keep that in mind. Now, I mentioned earlier under the S corporation, paying yourself a salary. I might have mentioned that briefly, but I didn't go into too much detail about this. When you incorporate yourself as an S corporation, you are no longer considered to technically be self-employed. You are now an employee of your own business. And I mentioned that the S corporation plays a very specific game called the reasonable salary requirement or reasonable salary ruling game, where you actually have to pay yourself a salary as a subchapter S corporation. Some of you might be thinking, well, that sounds too complicated. Why would I want to do that? Why don't I just want the profit to flow through? I pay tax on it and I'm done. Well, this is actually where the magic happens. Through issuing yourself a reasonable salary. The federal government, depending on what industry you operate in, whether you're in the real estate industry or the self-employed consulting industry, online sales business, the skydiving instructing business, each industry has a different reasonable salary requirement. For instance, attorneys and medical professionals tend to generate a lot more revenue with very low overhead. So the federal government requires those entities to pay their shareholders larger reasonable salaries. Whereas a real estate professional can take as low as a 40% reasonable salary, and on 60% that's left over in company profit, they are avoiding certain types of tax on 60% of that profit. So when you issue yourself a salary, it's not just you cutting yourself a check, it's actually formalizing payroll to yourself, putting yourself on a payroll W-2 and actually withholding Social Security and Medicare and state disability and unemployment insurance and employment training tax here in the state of California. So let's just break this down in numbers. Assume, just for ease of calculation, that your business has a net profit. So this is after all expenses are taken into account. Your company has a net revenue or net profit of $100,000. Pretty easy number to go off of calculation-wise. So we're going to start here. Now, if you are an LLC or a sole proprietor, basically a non-corporate individual, you are paying federal tax, state income tax, and Social Security and Medicare tax on the full $100,000 of profit. And as you can imagine, that could be a pretty sizable number. Social Security and Medicare alone is 15.3% of whatever your net profit is. So under an S corporation, that's as an LLC or a sole proprietorship. As a subchapter S corporation, you get to pay yourself a reasonable salary and avoid paying certain types of tax on about 60% of the company's profit. So imagine this, you take this $100,000 profit number, you pay yourself a 40% salary, so $40,000 W-2, and then your business gets to write you off. The business actually gets to deduct $40,000 of W-2 payroll salary. So 100 grand minus 40,000 leaves you with $60,000 in leftover flow through profit. And what you've just achieved here is proper tax avoidance. That is the result of what you're doing. Tax avoidance is completely legal. Tax evasion is not. So we're trying to avoid tax, not evade tax. So 100 grand minus the $40,000 W-2 gives you $60,000 in leftover flow through profit, right? Now, no matter how you split the 100 grand, when you add those two numbers back up, it equals 100 grand. Except in this scenario, what you've done is you've made one of these numbers subject to federal, state, Social Security, and Medicare tax. The other number, you are still subject to federal and state income tax, but you are not subject to Social Security and Medicare. So once again, $40,000 in payroll, subject to payroll tax and federal and state income tax, and the $60,000 that's left over under this subchapter S corporation entity pays federal and state tax, but it completely avoids paying 15.3% of Social Security and Medicare tax. To break this down into a little bit more detail, I've used this chalkboard. We've all seen the chalkboards in school, right? And so as you can imagine in the middle column here, so we broke it down, average federal tax rate of about 25%, average state tax rate of about 9.3%, and then self-employment tax of 15.3%. So as a sole proprietor or an LLC, you're paying the max tax rate across the board, as you can see in the first column here. As a subchapter S corporation, when you issue yourself a 40% reasonable salary, nothing changes from a federal and state income tax perspective, because when you add the 60 and the 40 up, it still equals 100 grand. That is in this scenario, that's your taxable income. But look what happens to your self-employment tax. It drops by up to 60% because you are no longer subject to self-employment tax on 60% of your company's profit. Now, once again, for a medical professional, the numbers will be a little skewed because medical professionals have to pay themselves a much higher reasonable salary. But for a real estate investor who can pay themselves as low as 40% reasonable salary payout, these are the numbers that you're essentially looking at on $100,000 of profit. So right out the gate, I mean, just by filing as a subchapter S corporation with 100 grand of net profit, you're saving or reducing your overall Social Security and Medicare tax obligation by upwards of about $9,100. Some of you might be thinking, well, I'm not nearly, I'm not even close to that 100 grand net profit level of income. What about half of it? Right? So let's cut 100 grand in half. Let's drop it down to $50,000. Even at $50,000 of net profit, you're still yielding an overall Social Security and Medicare tax reduction amount in the amount of $4,590. So if the annual cost of filing as a corporation costs you, let's say, $800 to the state of California, $25 to the Secretary of State. In other fees, in other states, it might be a little bit cheaper, but here in the state of California, it's about $825 minimum per year. Then you have to pay for tax preparation costs, which industry average can range anywhere from $700 or $800 all the way up to $4,000 or $5,000 for a corporate return, depending on the complexity of the return. So at the end of the day, let's say industry average is about $1,000 to file a corporate return. You got $825 to the state of California, $1,000 in preparation fees, and then maybe $1,000 in payroll processing costs, because you have to pay yourself on a quarterly basis or once at the end of the year or once every 6 months. But at the end of the day, payroll costs would be one and the same. It would just be about $1,000 in processing fees. So let's add that up. That's about $2,800 overall in preparation costs to handle pretty much everything, filing as a subchapter S corporation. And at $50,000 of net profit, you're yielding an overall tax savings amount of about $4,590. So you're still coming out ahead. You're saving almost double what it's costing you. So at 50 grand of net profit, it actually would make sense for somebody to entertain the idea of incorporating their business. Once again, incorporating is not right for everyone. These calculations have to be dialed in, with a tax advisor, with a licensed tax advisor, to make sure that financially this makes sense for you. The last thing we want to do is incorporate you, bury you in all these costs when your company is actually losing money in its startup phases or breaking even in its startup phases. This really only makes sense for individuals, self-employed individuals who have net profit at or above $45,000 to $50,000. Okay, so keep that in mind. Now, one very unique thing that came out of the 2018 tax reform bill is something called QBI, or the QBI deduction. No, it is not a new variant of COVID. QBI stands for Qualified Business Income. And this in particular is a flow chart showing you how the qualified business income deduction works. So if you're married filing joint, you're going to follow the screen to the left, so the blue column. If you are single, you're going to follow the red column. So let's use married filing joint as the example here. If my spouse and I are making, let's say, taxable income, after all deductions are taken into account, we've got net taxable income of $300,000. Well, the first threshold that we need to be aware of married filing joint is $329,800. It's a little blurry on the screen. I'm sorry, $329,800. So obviously 300 grand, we're below that threshold. So yes, my spouse and I would qualify for the full qualified business income tax deduction, which makes 20% of our qualified business income tax-free. Well, let's just for argument's sake, let's assume that the full 300 grand for my spouse and myself, let's say the full 300 grand is qualified business income. 20% of QBI in this scenario is $60,000. That means that because we are under the $329,800 threshold, the first $60,000 of our qualified business income pays zero federal income tax. So to qualify for this, it's all about getting you below a certain threshold. And as you can see, the thresholds are different for married filing joint versus single or head of household or married filing separate. Now, let's say that I'm slightly above the $329,800 threshold. It doesn't mean that I don't qualify for QBI or the QBI benefit. It means I start to phase out from being allowed the benefit. And at $429,800 married filing joint, I am fully phased out from being allowed the QBI deduction benefit. For single individuals, the thresholds are $164,900. Full phase out is $214,900. So just be aware that it's all about qualifying for this benefit. So don't you think it would be important to sit down with your tax advisor prior to the end of the calendar year, figure out creative strategies to help reduce your taxable income and potentially qualify for a 20% tax-free credit on all of your taxable income? Qualified business income. To me, it's the closest to free money as free money gets, right? Where you can put money into deferred retirement or reinvest money back into some of your rental investments, helping you reduce your taxable income and paying less income tax on your money earned. The ROI alone for a self-employed deduction, if you can bump yourself below one of these thresholds, the ROI alone could be in the 40% plus range. ROI stands for return on investment. So any dollar you're able to reduce your taxable income by is not only saving you federal, state income tax, plus it's reducing your self-employment tax by paying yourself a lower reasonable salary, but it's also qualifying you for more of the 20% qualified business income deduction. Some of your eyes might be rolling back in the back of your head right now thinking, oh my gosh, there's so much information here. Well, understand, I'm not trying to teach you everything that I know. I'm trying to show you some of the opportunities that you have as a self-employed taxpayer that you may have missed out on if you were working with a tax advisor that didn't understand how QBI worked or how the power of incorporating works. So make sure that you're working with a licensed advisor who understands corporate taxation and how to file properly under a subchapter S corporation and the differences between the three types of entities that we talked about, as well as how to qualify you for the qualified business income deduction. So keep all of that in mind. And every tax advisor, tax preparer is cut from a different cloth. We all had different levels of education. We all work in specific and unique industries and maybe focus on other things. Some accountants are jacks of all trade, masters of none. Some tax preparers focus on one industry and one industry alone. Here at Robert Hall & Associates, our senior advisors are well versed in the self-employed realm. And we, like I said, we incorporate over 250 to 300 entities almost on an annual basis. So we see a lot on both sides of the fence, not only the real estate side, investing, and using entities for greater liability protection benefit, but also on the self-employed side of things, utilizing entities to play the reasonable salary ruling game and help reduce overall income tax and keep more money in your pocket. Remember, what you see as tax savings, I look at differently. Sure, it is saving you tax, but I look at it as wealth retention. The more tax I can save you, the more I am assisting or helping you retain wealth. Because if you don't retain it, you end up paying it in federal and state income tax, right? So the goal here is to plan ahead to pay less income tax. And the government says it is the right of every taxpayer to plan ahead to pay less income tax and hopefully keep more of your own earnings in your own bank account rather than overspending with the federal and state agencies. Now, one other major benefit of being incorporated is that you no longer have to file an in-home office form, which runs probably one of the highest risks of audit out of any form on the individual return. As an incorporated entity, such as an S Corp or a C Corporation, you are actually able to rent out a space inside of your primary residence as an in-home office. So your corporation can actually pay you rent on a month-to-month basis or every 6 months or maybe one time at the end of the year to rent out space inside of your house. So no longer do you file this highly audited in-home office form, you actually end up filing a Schedule E rental investment form, which has a much lower risk for overall audit, and you get to take an allocation of the building and use depreciation to help reduce the rental income that you're now reporting on your personal return. So you actually have a contractual agreement with your corporation to rent out your office space inside of your home to the business. And we saw a lot of this happen during the pandemic years where more people were working from home than ever before, probably in the history of Internal Revenue Code. I don't have the exact stats on that, but as you can imagine, when brick and mortar started to become a thing of the past and everybody was doing Zoom calls and online webinars and things like that, people were working from home. So they were forced to convert that guest bedroom or that space inside of their house into an actual legitimate office space. So we've been seeing a lot more in-home office deductions pop up coming out of the pandemic years. And so therefore, we've actually structured people in ways where their corporation can actually rent out space inside of their home and essentially make rental income disappear into thin air legitimately. There's a whole part of the Internal Revenue Code that states that shareholder corporations that have offices inside of their homes, they can have this contractual agreement with their entity. So keep this in mind. It's not only for the billionaire corporations of the world, it actually is for small business owners as well. You just have to know how to play the game, how to utilize the code to your benefit and not overstep, right? Because the federal government draws the line in the sand and you can go right up to that line, but you don't ever want to step over. And it is very much, it's true. In the tax industry, there is something called interpretation of the tax code. And it is all about how your preparer interprets, or sorry, I messed up the word, interprets the Internal Revenue Code. I misspoke there, but it all is an interpretation of the Internal Revenue Code. So just make sure that you're working with a licensed advisor who understands how to utilize those parts of the code to your benefit. All right. Some of you might be thinking, well, Tony, you mentioned that California has a really high filing fee. What about incorporating elsewhere in the US? Well, sure, you can go elsewhere in the US and incorporate, probably for greater asset protection benefit, because every state has its own legal code, right? So you might achieve greater asset protection benefits out of Delaware or out of Nevada. I know Nevada and Texas offer series LLC filings, but that is more on the legal side. So you want to talk to an attorney about that. As far as filing fees are concerned, you're not going to go elsewhere in the US to save income tax, because California is very unique. California taxes its residents on their worldwide income. So California will follow you if you are a California resident, but you have revenue streams in other states and assets in other states that generate revenue. California will want a piece of that as far as tax is concerned. Now, sure, we have double taxation code or double taxation relief with most states, meaning that if you pay tax in New York, you get a credit on your California return, and then California is a credit on your New York return. So you don't pay tax twice, but you will end up paying the difference in tax rate amount. Let's say that another state has a 4% tax rate, but you're a California resident and you're in the highest income bracket, let's say at 9.3%, you would pay the difference of 5.3% to the state of California. Not exactly that calculation, but I think you understand the gist of what I'm trying to say. So you have to make sure that when you go elsewhere to incorporate, you understand that you're not avoiding California income tax, that there may still be obligations, not only in California, but also in the other state that you're filing out of. So just be aware of that. Have this conversation with your tax advisor. Another really important thing to understand is the differences between the insurance policy, the living trusts, and the LLC or entity structures. Just because you have a $5 million umbrella insurance policy doesn't mean that you are protected in case an unforeseen event happens. LLCs and S Corps and C corporations are great for separating assets and liability between personal and business assets. But as far as actual protection, a dollar payout is concerned, insurance policies are by far the most important thing for us to have because of that dollar payout. Once again, we have health insurance in case we get sick. We have car insurance in case we're in a car accident. We have liability insurance in case we're, ever pursued legally speaking on the legal side of things. We have malpractice insurance, E&O insurance, earthquake insurance, fire or hazard insurance, right? So we all have insurance, and insurance policies are there and in place to pay out settlements in case an unforeseen event happens. What an insurance policy does not do is it does not separate or allow you to separate business and personal liabilities. That is what an entity structure does. Now, when does a trust benefit kick in? One major life event has to happen in order for a trust to kick in and really provide any benefit to you. And unfortunately, that life event is death. So a trust is really meant to protect us after we leave this earth onto something bigger and better, right? That is meant to protect us from probate and keep our assets from going into probate after death. And at that point, then your loved ones don't have their, allocated mourning period, the mourning of a loved one who's just passed, and they have to dive into their own savings or into the legacy that you've left them and fight the state of California or whatever state they're living in probate court to obtain all of the assets that you've worked your whole life to build, right? The wealth that you've built for yourself and the portfolio that you've built for yourself. So having each one of these things in place is very important. Is it necessary for all of us? No. If you don't own personal assets, if you don't have a profitable business, if you're just getting started in business or or acquiring your first property, you don't need the living trust. You don't need the LLC right out the gate. I think we all need some sort of insurance policy, but at the end of the day, these things will fall into place. These doors will start to open for you as you start to build wealth and build legacy. So the proper way to structure all of this is, let's say you're going out and you're buying a rental property. You would have an insurance policy attached to the property. The property would be owned under the LLC, and then the owner of the LLC would not be you individually. It would be the living trust. So if somebody ever sues you, insurance kicks in, or if the house burns down, insurance kicks in and rebuilds the home. If somebody sues you personally, you don't own the property, your LLC owns the property, and then heaven forbid something happens and you pass away. Now the trust inherits the properties and allows for a smooth transition or transfer of assets to your beneficiaries, because that's where the benefit is in a living trust. It's your beneficiaries, hence the name beneficiary. they are the ones that benefit from the living trust or the irrevocable trust or, revocable trust, or even an estate. But our estate attorneys and our trust attorneys here at Robert Hull & Associates, they're great. They can advise more on the end of life planning side of things. We can advise on all of the income tax side. So just keep us in mind when you have questions regarding any of those topics. Do we need all three of these? Not right out the gate, but eventually you will as you start to build wealth and want to retain wealth and protect your assets and your legacy. Now, moving forward into 2022, as we move forward into 2022 and into 2023, we look forward to having a new tax bill on the horizon. Nothing has really been passed as of today, but I do want to mention that once that bill does pass, we will be updating our webinars and making sure that we're bringing the most current information to all of the listeners in this course. But one thing is for sure, I truly believe that any changes that do happen, in the upcoming months or years, that these changes will be tweaked over the next 2 to 3 years. They will be changed. They will be altered. Some things will be removed. Some things added. It's just it's common practice under Internal Revenue Code for things to be altered as time passes. Things adjusted, things added, things removed. So just be aware that once we have that final bill and that is set in stone, those things can still change. We have a good idea of what our base approach will be based on that tax bill once it passes, but things will be tweaked and changed as the years move forward. And it could change under under new administrations. We saw that in 2012. We saw it in 2018. We're going to see it in 2022, 2023. So in future years, when a new administration comes in, they could completely alter the Internal Revenue Code again. So our head will always be on a swivel, right? Good old federal government and Internal Revenue Service. But that is why you hire tax advisors to advise you once these changes come through, to advise you on the best positions to take, the safest positions, but being safely aggressive. You don't want to just not take a deduction because it thinks it increases your risk for audit. If the IRS says it's an allowed deduction, take it. If you're working with a tax advisor who says, hey, we shouldn't take this, even though the IRS says you can take it, we don't want to take it because it's going to increase your risk for audit, that is not the right approach. Because at the end of the day, the representatives who file your returns should also be representing you in front of the Internal Revenue Service in case any of that work is being questioned under audit. So just be aware of all of that. I did want to leave you with this screen just to, let you know again that we do offer free 30-minute in-person or over-the-phone consultations. These consultations are to review 2 years of tax returns, to check for any possible audit triggers on your return, and then also to add you to our periodic tax email update, and also let you know when our free educational webinars are going to be coming up over the next couple months. We do about 140 events per year. We attend expos all over Southern California, so you may have seen our booth at an expo that you've been to. Come by and say hi. But thank you so much for taking today's course, and we look forward to speaking with you soon.